Hi, hello, welcome to all of you. This is Dr. Manjunath N, Assistant Professor from Department of Commerce and Management Studies, Government First Grade College, Srinivaspur. This session is particularly designed to BBA 5th semester students of Bangalore North University. In this session, we are going to discuss about the subject called investment management. The topic for the session 28 to session 42 is portfolio rebalancing. Before going to discuss about this particular topic, let us understand what are the concepts that we discussed in the previous class. We have discussed the portfolio revision in the previous class as an introduction part. The learning objective of this chapter is to provide an overview of portfolio management strategies, portfolio revision and rebalancing, and apply the various measures for evaluating a portfolio. The session outcomes is the student will be able to understand the concept of rebalancing the portfolio. Portfolio rebalancing. Risk management plays a significant role in effective portfolio creation, regardless of your investment style or approach. Investors who take risk management seriously and take a proactive attitude to realigning their portfolios are more likely to prevent major blunders when the bull market start catering. Rebalancing portfolios is rarely done by the people but is extremely essential to your investment approach. What is portfolio rebalancing then? Portfolio rebalancing is the method of modifying your asset allocation as the amount of money in each investment fluctuates with the ever changing economy. Everything boils down to one thing: asset allocation, that is how much money you are investing in your portfolio in certain asset classes. In other words, portfolio rebalancing is the weighting method of an asset portfolio. Rebalancing includes purchasing of or selling assets in a portfolio regularly to preserve an initial or desired amount of asset allocation or risk. For instance, say 50% stocks and 50% bonds were in initial target asset allocation. If shares performed well over the period, the stock weighing could have risen to 70% of the portfolio. Then the investor may decide to sell some stocks and purchase bonds to return the portfolio to the initial 50 and 50 target allocation. When to rebalance your portfolio? So here is the answer. With a diverse combination of different kinds of investment, your investment strategy is likely to be designed for the long term. But there are times when you need to consider rebalancing the portfolio. It may be time to review your portfolio and consider rebalancing your investment mix if, for example, changes in your tolerance to risk. A financial goal must be achieved, such as assisting a kind pay for a particular source. Your near retirement, you can rebalance your portfolio to restore the asset allocation you want when your investment goals, time horizon, and risk tolerance change. Just remember that using asset allocation does not ensure yields or defend you against the future losses. How portfolio rebalancing works then? That is the big question. Say the stock market benefits have swelled your portfolio stock part over the previous 3 years. You can return to your initial allocation if the present level is too big for your risk tolerance. How are you going to do that? You can transfer cash from stocks to other asset classes such as bond and money market funds. Or you can invest more in asset classes that are underrepresented until you reach the total allocations you want. Try automatic rebalancing. Rebalancing can be regular and automatic depending on the type of investment. Funds such as asset allocation funds divide their equity wealth between stocks, bonds, and money. Rebalancing becomes automatic to remain within the goals and risk parameters of the portfolio. Why is rebalancing important for you? The primary objective of portfolio rebalancing is to establish better risk control and ensure that your portfolio is not singularly dependent on the success or failure of a particular investment asset classes or fund type. For example, let's assume that you invested rupees 10,000 in mutual fund A and rupees 10,000 in mutual fund B in January 2018. At the end of the year, your investment of rupees 20,000 doubles up and returns into a dividend of rupees 41,000 due to market forces. It may happen that both the funds may not perform equally. So while Fund A gives you rupees 17,000 at the end of the year, Fund B returns rupees 24,000. When you began your investment, both the funds had the same weight. At the end of year one, one fund dominated your portfolio with a roughly 60% share. If in the coming years this fund were to perform badly, when your investment would see a downward turn in no time at all. How can rebalancing helps you as an investor? That is the question. Rebalancing works as a risk minimizing strategy for you as an investor. It allows you to line up your investment with your goals by periodically rebalancing your portfolio. If your risk tolerance or your investment strategies change, when you can rebalance the weight of the asset class in your portfolio by reassessing and devising a new asset allocation. How can you rebalance your portfolio? When you invest in mutual funds, you are investing to achieve a single goal via various vehicles. So when you rebalance, the shift must occur across all of these funds at the same time. Here is how you can rebalance your portfolio in 5 simple steps. Step number 1. Primarily, have an asset allocation plan by considering your income, the expected time of retirement, and so on. Create an asset allocation framework, but if you are unsure, speak to an expert. Step 2. Assess your current asset allocation by identifying where and how your current investments are placed in stocks, cash, bonds, or any other form of investment. After this, make a comprehensive analysis of asset allocation target and its present state and make adjustments accordingly. Step 3. Chart out a rebalancing plan. Is your asset allocation target does not align with your current portfolio. This step can be tricky where you have to decide on the securities to retain and in what numbers. Speak to your experts, especially in investment experts. Step 4. Be mindful of the tax implications, especially on capital gains. Avoid the short-term taxes on capital gains by holding on to your equities for over a period of time or over a year. In the case of debt funds, the short-term capital gains will qualify for taxes based on the individual's income tax slab. For long-term capital gains, the tax is 20% with indexation. If you need to scale back, aim to sell the securities in the tax exempt accounts first. In this way, you can limit the taxes you pay in capital gains. Step 5. Review your portfolio at least once a year or maybe once in 6 months to assess your position, but rebalance it only when you feel that the allocations are significantly out of the track to reaching the target. To summarize this session, the primary objective of portfolio rebalancing is to establish better risk control and ensure that your portfolio is not singularly dependent on the success or failure of a particular investment, asset class, or fund type. To understand this session much more better, we can understand through some of the multiple choice questions. Let us discuss about some issues on rebalancing of portfolio. Number one, dash is the method of modifying your asset allocation as the amount of money in each investment fluctuates with the ever-changing economy. Option A, portfolio strategy. Option B, portfolio management. Option C, portfolio revision. Option D, portfolio rebalancing. Any guess the answer for this? The answer is answer D, portfolio rebalancing. Similarly, we have another question. Portfolio rebalancing is the dash of an asset portfolio. Option A, research method. Option B, weighing method. Option C, learning method. Option D, earning method. Can anybody guess the answer for this? The answer is answer B, option B, weighing method. Portfolio rebalancing is the weighing method of an asset portfolio. We have another question. Rebalancing includes dash assets in a portfolio regularly to preserve an initial or desired amount of asset allocation or risk. We have four options. Option A, purchasing or selling. Option B, demand and supply. Option C, make or buy. Option D, balance or rebalance. Any guess answer for this? The answer is option A, purchasing or selling. Rebalancing includes purchasing or selling assets in a portfolio regularly to preserve an initial or desired amount of asset allocation or risk. We have one more question. Rebalancing can be dash depending on the type of investment. Funds such as asset allocation, Funds divide their equity, wealth between stocks, bonds, and money. Any guess? Guessing answer? We have options. Option A, interest and demand. Option B, sell or buy. Option C, regular and automatic. Option D, financial or physical. Any guessing answer? The answer is option C, regular and automatic. We have another question. Rebalancing works as a dash strategy for you as an investor. Option A, rate of return. Option B, financing. Option C, risk maximization or maximizing. Option D, risk minimizing. What could be the answer for this filling the blanks? The answer is option C, risk maximizing. Like that, dear friends, we have various books and references are available to understand these concepts in a systematic manner. So that I request all of you to go through these references and books. And thank you for your patience listening. And I wish you all the best and good luck. Thank you very much.